In 2008, Lehman Brothers collapsed. It was a bank. Or was it? Lehman held $639 billion in assets, but only $25 billion were deposits insured by the government. The rest, created through a parallel financial system most people have never heard of. When Lehman fell, it triggered a freeze not in traditional banking, but in the shadow banking system, a $65 trillion network operating outside regulation, outside deposit insurance, outside democratic oversight. The bailout to save it, $16 trillion, more than the entire federal budget, more than all government programs combined, created by the Federal Reserve without a single congressional vote. Welcome to Financial Rewind. I'm here to expose the money creation happening in the dark. And today, we're revealing the shadow banking system, the parallel financial universe that creates more money than all the world's central banks combined, answers to no voters, and nearly destroyed the global economy. This is how you build a monetary system in secret, not through legislation, through financial engineering so complex that by the time anyone understands it, it's too late to stop. New York, 1971. A money market fund is invented. Not a bank, not regulated like a bank, but it offers something banks can't: higher interest rates on deposits. How? By investing in short-term corporate debt instead of making loans. No reserve requirements, no deposit insurance, no regulations designed for banks. It's called shadow banking because it does what banks do: create credit, enable spending, but in the shadows of regulation. The first fund is small, a few $1 million. By 2007, shadow banking assets reached $20 trillion, larger than the entire traditional banking system. And no one outside Wall Street really understands how it works. Here's what happened in those 36 years. Wall Street discovered a loophole. Banks are regulated. They must hold capital reserves. They're limited in how much they can lend. They're supervised by government agencies. But what if you could do banking without being a bank? What if you could create credit without calling it a loan? What if you could take deposits without calling them deposits? The shadow banking system was born from that question. And it created an entirely new form of money that exists nowhere in official statistics. Here's how shadow banking creates money, and why it's more dangerous than anything central banks do. Traditional banking is simple. You deposit $100. The bank keeps $10 in reserve, lends $90. That $90 becomes a deposit somewhere else. The cycle repeats. Money multiplies. But there are limits. Reserve requirements, capital ratios, supervision. Shadow banking removes all limits. Step 1. A corporation needs short-term cash. Instead of going to a bank, it issues commercial paper, essentially an IOU promising repayment in 30 to 90 days. Step 2. A money market fund buys that commercial paper with money from investors who think they're just holding cash in a safe account. Step 3. The corporation now has cash to spend. The money market investor thinks they have cash they can withdraw anytime. Both believe they have money, but only one piece of actual currency exists. The rest is created through the transaction. This is money creation. Just like banks, except no one is supervising it. Now scale this up. Lehman Brothers alone issued $150 billion in commercial paper. Goldman Sachs, $100 billion. Morgan Stanley, $75 billion. And these are just the simple instruments. The real shadow banking happens through repos, repurchase agreements. Here's how a repo works. Investment Bank A has $1 billion in mortgage-backed securities. It sells them to Investment Bank B with an agreement to buy them back tomorrow for $1 billion plus interest. Investment Bank A just got $1 billion in cash for one day. Investment Bank B just got collateral it can use for its own repo with Bank C. That $1 billion in securities gets used in 5 different repos simultaneously. Each creates money purchasing power that didn't exist before. By 2007, the repo market was processing $12 trillion daily, every day, more than the GDP of most countries. And most of it was overnight funding that had to be renewed every 24 hours. The entire system was running on trust that tomorrow's repo would happen. When Lehman collapsed and trust evaporated, the repo market froze. $12 trillion in daily funding disappeared overnight. Companies that were solvent on paper couldn't access cash to pay employees. The financial system locked up, not because banks failed, because shadow banks failed, and nobody had even known they were banks. Let's talk about what this looked like before the crash. A hedge fund wants to buy $100 million in mortgages, but it only has $5 million in cash. In traditional banking, that's impossible. You can't lend $100 million with $5 million in deposits. But in shadow banking, easy. The hedge fund uses the $5 million as collateral to borrow $95 million through a repo. Now it has $100 million. It buys the mortgages. then uses those mortgages as collateral for another repo to borrow $200 million more. It's called leverage. And in shadow banking, leverage ratios of 3, 0 to 1, or even 5, 0 to 1 were common. Lehman Brothers had 3, 0 to 1 leverage when it collapsed. For every $1 of actual capital, it had created $30 in credit. Bear Stearns, 3, 5 to 1. When their assets fell just 3%, they were insolvent, because a 3% loss on $30 wipes out your $1 of capital completely. Traditional banks are limited to around 1, 0 to 1 leverage by regulation. Shadow banks had no limits, and they used that freedom to create mountains of credit on hills of capital. It worked brilliantly, until it didn't. Here's the mechanism that made it systemic. Shadow banks don't just exist in isolation. They're interconnected with traditional banks through thousands of transactions. A traditional bank lends money to a hedge fund. The hedge fund uses it in a repo with an investment bank. The investment bank uses the collateral in a deal with a money market fund. The money market fund has depositors who think their money is safe. It's a chain, and every link depends on the next link functioning. In 2007, subprime mortgages started defaulting. Not a huge percentage, maybe 5% to 8%, but that was enough, because the securities backed by those mortgages were collateral in repo chains stretched across the entire shadow banking system. When the collateral lost value, repo lenders demanded more collateral or refused to renew repos. Suddenly, firms that had been funding themselves with overnight repos couldn't get funding. Bear Stearns collapsed in March 2008. It wasn't a bank. It was an investment bank, a shadow bank. Lehman collapsed in September 2008. Same story. AIG, the insurance giant, collapsed because it had sold credit default swaps insurance on mortgage securities to shadow banks across the system. When claims came due, AIG couldn't pay. And here's the crucial part. The Federal Reserve couldn't just step in and save them like it saves traditional banks, because shadow banks aren't banks. They're not regulated by the Fed. They don't have deposit insurance. They're not part of the official system, except they were. Functionally, they created credit. They funded the economy. They were banks in everything but name. When they collapsed, the entire financial system collapsed with them. So the Federal Reserve did something unprecedented, something that revealed the true nature of power in modern finance. Without congressional approval, the Fed created $16 trillion in emergency loans, asset purchases, and guarantees. Not to banks, to shadow banks, to hedge funds, to foreign central banks, to corporations. The official bailout TARP was $700 billion and required congressional approval. But the Fed's shadow bailout was $16 trillion and required no vote, no debate, no democratic process. An audit by the Government Accountability Office in 2011 revealed the full extent. $9 trillion in overnight loans to banks and shadow banks, $3.3 trillion in currency swaps to foreign central banks, $2 trillion in asset purchases, mortgage-backed securities, corporate bonds, $1.5 trillion in other emergency programs. Total, $16.1 trillion. This was money creation on a scale never seen in human history, and it happened in secret, revealed only years later through audits and FOIA requests. The Federal Reserve's chairman, Ben Bernanke, defended it. We had to save the financial system. There was no time for congressional approval. But here's what that means. Unelected officials at the Federal Reserve decided which institutions lived and which died. They picked winners and losers in a crisis they helped create through decades of looking the other way while shadow banking exploded. And they funded it by creating money that dilutes the value of every dollar held by every citizen. No vote, no accountability, just power exercised in an emergency. Let's talk about who benefited from that $16 trillion. Goldman Sachs received $814 billion in emergency loans and guarantees, not $814 million billion with a B. Morgan Stanley, $2.04 trillion. Citigroup, $2.5 trillion. These weren't struggling small banks. These were the largest financial institutions on earth, and they received more in emergency funding than the entire GDP of most countries. But it gets worse. The loans were at interest rates as low as 0.01%, essentially free. Goldman Sachs borrowed $600 billion at 0.01% interest, then invested it in treasury bonds paying 3% interest. Risk-free profit, hundreds of millions in earnings. From a crisis they helped create. And foreign banks, they got bailouts too. Deutsche Bank, $354 billion. Royal Bank of Scotland, $84 billion. Barclays, $868 billion. The Federal Reserve, using American dollars, backed by American taxpayers, bailed out foreign shadow banks that had gambled on American mortgages. No congressional approval, no public debate, just emergency powers exercised in secret. Now here's the part that should terrify you. The shadow banking system is bigger today than it was in 2008. After the crisis, regulators promised reform. Dodd-Frank was passed in 2010, Volcker rule banned proprietary trading, capital requirements increased. But all of those regulations applied to traditional banks. Shadow banking? Still largely unregulated. By 2023, global shadow banking assets reached $200 trillion, 3 times the size of traditional banking. The instruments have new names. Collateralized loan obligations instead of collateralized debt obligations. Leveraged loans instead of subprime mortgages. But the structure is identical. High leverage, complex interconnections, reliance on short-term funding that can disappear overnight. And it's creating money at a scale that makes central banks look irrelevant. The Federal Reserve creates money through bond purchases and interest rate policy, maybe $4 trillion total since 2008. Shadow banking creates money through repos, commercial paper, money market funds, and derivatives, over $200 trillion globally. It's a parallel monetary system. And no voter approved its existence. Here's a specific example from 2019 that proves the system hasn't changed. September 2019. The repo market suddenly froze again. Overnight interest rates spiked from 2% to 10% in a single day. Banks and hedge funds that needed overnight funding couldn't get it. The Federal Reserve stepped in immediately, injected $75 billion per day into the repo market, every day, for months. By the end of 2019, the Fed had injected $500 billion into repo markets. Why did it freeze? No one knows for sure. The banks won't say. The hedge funds won't disclose. But the structure is clear. The shadow banking system was over-leveraged again, and when something caused a liquidity squeeze, the Fed had to bail it out again. This time there was no headline crisis, no Lehman collapse, just a quiet bailout that most people never heard about, because the shadow banking system is too big to fail, and the Federal Reserve knows it. Every time it freezes, the Fed intervenes, creates money, bails out shadow banks, without asking Congress, without asking voters, just exercising emergency powers that have become permanent. Let's talk about the legal structure that makes this possible. The Federal Reserve was created in 1913 as an independent central bank. The idea, insulate monetary policy from political pressure. But independent has come to mean unaccountable. The Fed's board is appointed by the president and confirmed by the Senate. But once appointed, they serve 14-year terms and can't be removed. They don't answer to Congress. They don't answer to voters. They answer to themselves. And their power has expanded far beyond the original mandate. Originally, the Fed could only lend to member banks, backed by solid collateral. But Section 133 of the Federal Reserve Act, added during the Great Depression, allows emergency lending to any individual, partnership, or corporation if approved by the Treasury Secretary. This clause was used once between 1932 and 2008. In 2008, it was used to justify lending to Bear Stearns, AIG, money market funds, commercial paper issuers, and foreign central banks. In 2019, it was used to justify repo market interventions. In 2020, during COVID, it was used to justify corporate bond purchases, municipal bond purchases, and direct lending to corporations. The emergency has become permanent, and the power has become absolute. The Federal Reserve can create unlimited money and lend it to anyone it deems systemically important. No vote required, no oversight, no limit. As long as the Treasury Secretary agrees and the Treasury Secretary is appointed by the same president who appoints Fed governors, the Fed has unlimited power to create money and direct it wherever it chooses. This is not democracy. It's monetary autocracy hidden behind technical language. So what does this mean for you? It means the money supply is being expanded by entities you didn't elect, through mechanisms you don't control, to benefit institutions you'll never see. Every time the Fed creates $500 billion for repo markets, your dollars lose purchasing power. Every time shadow banks create $10 trillion in leveraged credit, they're diluting the currency you work for. And when the system collapses, not if, when you pay for the bailout through inflation, austerity, or both. But the shadow bankers, they keep their profits, they keep their bonuses, they keep their positions. In 2008, not a single major banker was prosecuted. Not one. The excuse, it's not illegal, it's just unethical. And why wasn't it illegal? Because shadow banking operates in regulatory gaps, doing things that look like banking but aren't technically banking, calling deposits money market shares, calling loans repos, calling leverage sophisticated financial engineering. It's legal fraud. The system is designed to allow it. Here's the human cost. 2008 financial crisis. 10 million Americans lost their homes to foreclosure, not because they stopped paying, because the value of their homes collapsed when shadow banks stopped creating credit. $19 trillion in household wealth evaporated. Unemployment hit 10%. An entire generation graduated into the worst job market in 80 years. Meanwhile, the shadow banks that caused it, Goldman Sachs paid out $20 billion in bonuses in 2009. The year after the bailout, Morgan Stanley, $14 billion in bonuses. JP Morgan, $26 billion. They paid themselves with money borrowed at 0.01% from the Federal Reserve. The profits were privatized, the losses were socialized, and the system that enabled it continues to operate in the shadows. Could this be stopped? Yes, but it would require treating shadow banks like banks. Require capital reserves for all credit creation, not just traditional deposits. Regulate repo markets like deposit accounts. Limit leverage across the entire financial system, not just banks. Make the Federal Reserve subject to real congressional oversight with the power to override emergency lending. These reforms are technically simple, politically impossible. Because shadow banking is where the real money is made. Goldman Sachs doesn't make money from savings accounts. It makes money from leveraged trading, repos, derivatives, shadow banking. JP Morgan doesn't make billions from checking accounts. It makes billions from credit default swaps and structured finance shadow banking. The financial industry's profits depend on shadow banking remaining in the shadows. And the financial industry funds campaigns, lobbies Congress, and revolves through Treasury and Fed appointments. The system regulates itself, and it chooses not to. So we're left with a parallel monetary system that creates more money than all central banks combined, operates outside democratic oversight, requires bailouts funded by taxpayers when it fails, enriches a tiny elite while risking systemic collapse, and continues to grow despite having nearly destroyed the global economy. This isn't capitalism. It's not even a free market. It's a rigged game where profits are private and losses are public, where money is created in secret and distributed to the connected, where voters have no say, oversight is impossible, and the next crisis is being built in real time. In 2008, shadow banking created $65 trillion in assets. It collapsed, requiring $16 trillion in bailouts. Today, shadow banking has created $200 trillion in assets, 3 times larger. The leverage is higher. The interconnections are deeper. The reliance on overnight funding is greater. And the Federal Reserve is already intervening quietly to prevent freezes. History doesn't repeat. It reveals, and right now it's revealing a simple truth. The shadow banking system creates money no voter ever approved, enriches people you'll never meet, and will collapse again. The only question is when. And when it does, the bailout will be bigger, the money creation will be larger, the democratic override will be more complete. Because the system isn't designed to prevent crises, it's designed to profit from them. Welcome to the shadow, the parallel financial universe where money is created in the dark, distributed to the few, and guaranteed by the many. The system you didn't vote for, can't audit, can't stop. The one that's 3 times larger than when it nearly destroyed the world.